If you're thinking about selling an investment property, whether that's a rental home, a condo, a duplex, or even an apartment complex or a motel here at the Jersey Shore or anywhere in the country, there's something really important you should know before you make that decision. There may be a way for you to defer paying capital gains taxes on that sale, and it's called a 1031 exchange. And for a lot of property owners, this can mean keeping tens of thousands, sometimes even hundreds of thousands of dollars working for you instead of going straight to taxes. And I'll be honest with you, this is one of those things that a lot of people don't fully understand until after they've already sold, and by then, it's too late. So today, I want to walk you through how a 1031 exchange works in a really simple, real-world way so you can understand if this is something you should be thinking about before you sell. If you're new here, I'm Jessica Lees with Lees Real Estate Agency, and we help buyers and sellers navigate the Wildwoods market every single day. So let's start with the basics. At its core, a 1031 exchange is a tax strategy that allows you to defer paying capital gains taxes when you sell an investment property, as long as you reinvest that money into another investment property. And the key word there is defer. This is not eliminating taxes forever, it's postponing them so you can keep more money invested and working for you instead of writing a large check right away to the IRS. Now, this only applies to certain types of properties. We're talking about investment properties, rental income properties, things that produce income. This does not apply to your primary residence. So if you're selling your personal home or second home, that's a completely different conversation. But if you own a property held for investment purposes, this is exactly where a 1031 exchange can come into play. And the reason this matters so much is because when you sell an investment property, you're not just dealing with one tax. You may be looking at capital gains tax, depreciation recapture, and possibly state taxes as well. And for a lot of people, especially if you've owned the property for a while and it's gone up in value, that number can be significant. I've seen situations where sellers are looking at $50,000, $80,000, and sometimes well into six figures in taxes. So instead of paying that immediately, a 1031 exchange allows you to roll that money into your next property, deferring the tax. That means you now have more buying power, more money working for you, and more opportunity to grow your investment. And I'll give you a really simple example because this is where it usually clicks for people. So let's say you sell a rental property and you're looking at about $80,000 in taxes. If you don't do a 1031 exchange, that 80 grand is gone. It goes to taxes and it's no longer part of your investment. But if you do a 1031 tax deferred exchange, that $80,000 stays in the deal. So now instead of reinvesting a reduced amount, you're reinvesting the full proceeds into your next property. And that can significantly change what you're able to buy, how quickly you can grow your portfolio over time. It's just the best way to do it if you can. And I'll tell you, this is where I've seen this make a real difference for people. I've worked with sellers who have owned a property for a long time, especially here at the shore, and they don't realize how much their tax exposure actually is until they start looking at the numbers. And when they see it, it's a little bit of a shock because they're thinking about the sale price, but they're not thinking about what they're actually walking away with after taxes. And when you start looking at it that way, a 1031 exchange can completely change how you approach the sale. Because now it's not just about selling, it's about repositioning your investment. So let's talk about how this actually works, because this is where people tend to get tripped up. The first thing you need to understand is that you cannot take possession of the money from the sale. That's probably the most important rule in the entire process. Instead, the sale proceeds funds go to something called a qualified intermediary. Think of them as a neutral third party who holds the money while you go out and purchase your next property. If that money hits your account, even for a moment, the exchange is no longer valid. So this has to be set up before you close on your sale. And this is actually one of the biggest mistakes I see. People don't plan ahead. They sell the property, the money hits their account, and then they start asking about a 1031 exchange. And at that point, there's nothing you can do. Once the sale is done and the funds are in your possession, the opportunity is gone. And that can be a very expensive mistake because we're not talking about small numbers here. We're talking about tens of thousands, sometimes even over $100,000, and that could have stayed invested. So even if you're not sure you want to do a 1031 exchange, just knowing that it exists before you sell can make a huge difference. Now, once your property closes, there are two very important timelines you need to be aware of. The first is the 45-day rule. From the day you close, you have 45 days to identify potential replacement properties. And that time goes by fast, especially if you're trying to evaluate different options or waiting for the right property to come on the market. Then you have a total of 180 days from the sale to actually close on one of your replacement properties, or multiples if you're buying multiple properties. So you're working within a defined window and there's not a lot of flexibility. Missing those deadlines is another big mistake I see, because once those timelines pass, the exchange is no longer valid. So let me walk you through what this actually looks like in a real life scenario. Let's say you own a rental condo in Wildwood and you decide to sell it. Before you close, you set up your 1031 exchange with a qualified intermediary. The property sells and the funds go directly to the intermediary, not to you. Now your 45-day clock starts. During that time, you're looking at potential replacement properties. Maybe you're considering a duplex, maybe a larger condo, maybe even two smaller properties or a strip mall in another state. You identify those properties within the 45 days and then you move forward and close on one of them within the 180-day period, or multiples if you're buying multiple properties. So that's what this looks like when it's done correctly. And when it is done correctly, it can be a very powerful tool. Now, another thing that confuses people is the term like kind. A lot of people assume that means you have to buy the exact same type of property, but that's actually not true. Like kind simply means investment property for investment property. So you could sell a condo and buy a multifamily. You could sell one property and buy multiple properties. You can also sell multiple properties and buy one property. You could sell a house and buy a motel. There's actually a lot of flexibility there. Another common question I get is, do you have to buy something bigger? And the answer is, not necessarily. But if you want to fully defer your taxes, you generally need to reinvest all of the proceeds and purchase something of equal or greater value. So that's another area where planning becomes really important. You can buy for a lesser amount, but the difference in what you spend and what was available to you will be taxed. Now let's talk about a couple other mistakes I see. One is rushing into the wrong property just to meet the deadline. People feel pressure as that 45-day window gets closer, and they end up buying something that doesn't really fit their long-term goals. Another is not working with the right team. A 1031 exchange involves coordination between your agent, your intermediary, and your CPA. If those pieces aren't aligned, things can get complicated really quickly. And another big one is just not having a clear plan going in. If you're selling a property, you should already have a general idea of what direction you want to go in next. Now let's talk about how this plays out locally in the Wildwoods in Cape May County, South Jersey, because this is where it becomes very real. In the Wildwoods, I see investors use 1031 exchanges in a few different ways. Sometimes they're upgrading from smaller condos into larger income-producing properties. Sometimes they're consolidating multiple properties into one higher value asset. And sometimes they're simplifying, moving out of something that requires a lot of management into something more passive, or moving from one state to another. For example, someone might sell a smaller rental condo and move into a duplex or a triplex that generates more income. Or they might decide they want less day-to-day involvement. It really depends on their goals, and that's what makes the strategy so powerful. It gives you options. And I also want to be clear about something else. A 1031 exchange is not always the right move for everyone. Sometimes sellers actually want to take the cash out. Maybe they're done managing properties. Maybe they want to simplify their finances. Maybe they want liquidity for something else. And in those cases, paying the taxes and moving on might actually be the better decision. So this isn't about saying everyone should do a 1031 exchange. Far from it. It's about understanding that you have the option and then deciding what makes the most sense for you and your personal situation. And I'll give you a few quick pro tips if this is something you are considering. So listen up. Start early. This is not something you want to figure out once your property is already under contract. Line up your team. You want your agent, your intermediary, and your CPA all on the same page. And have a general idea of what you want before you sell. because the biggest stress point in a 1031 exchange is that 45-day window. If you already have direction, that process becomes much easier. But if you've owned a property for a while and it's appreciated, this is definitely something you should at least explore before you sell. Because once you sell without doing a 1031 exchange, the opportunity is gone, like I said. And one thing I always tell sellers is this: even if you're not sure you want to do one, it's worth understanding your options and how it all works before you list your property. Because language to allow the 1031 tax exchange needs to be included in your contract of sale. If it's not, then you need an addendum to add it. And once the deal's closed, again, you don't get that second chance to structure it differently. So even just having that conversation early on can make all the difference. So my biggest advice in all of this is this: if you're even thinking about selling an investment property, start planning early. Understand your options, talk to your agent, talk to a qualified intermediary, talk to your CPA. That way you can make a fully informed decision before you move forward. Because sometimes a 1031 exchange makes a lot of sense and sometimes it doesn't, but you want to know that before you sell and not after. If you're thinking about selling an investment property in the Wildwoods and want to explore whether a 1031 exchange could work for you, feel free to reach out. I'm happy to go over all the details, walk you through your options, and help you think through what your next move could look like. Again, I'm Jessica Lees with Lees Real Estate Agency. If you found this helpful, make sure to like and subscribe, because we're going to be putting out more videos about buying, selling, and investing here in the Wildwoods, Cape May County, and the Southern Jersey Shore. Thanks for watching, and I'll see you in the next video.